Next up, we have Chase Edgelow from EverGen Infrastructure. EverGen is a renewable natural gas play that's capitalizing on decarbonization trends in Canada to reach net zero emissions. They currently own and operate 3 RNG facilities in BC, with interest in new development projects in Alberta and Ontario. As a fairly new company, we like that they already have 10 million in revenue, 3 million in EBITDA, and 20 million of cash that will help them fund their current development pipeline, which should take them to 30 million in EBITDA over the next 12 to 18 months. With that out of the way, I'll turn everything over to Chase and he can walk us through the story. Hey, Chase, how are you?
Great. Thanks, Deborah. Thanks for having us. Thanks to the Adelaide team. And it was a great introduction by Jennifer and really interesting conversation that Ryan brought up as well about another form of RNG that looks really exciting.
Awesome. Well, looking forward to hearing the EverGen story. Do you have some slides you want to share? Or are you just going to walk us through
it? Sure. I'll put up some slides as well, but we'll start at the high level. I think we've put together a portfolio of assets at EverGen over the past 2 years that I think we've had our eye on for a lot longer than that. With the view that we're operating at the intersection of, I think, a couple of themes that Jennifer touched on, which is organic waste that needs a home and needs a long-term sustainability focused solution versus traditional methods of landfilling organics, and providing green energy through renewable natural gas. And we, in particular, focus on Canada for a couple of reasons. I think one of the key reasons is that up until recently, FortisBC has been leading the charge as one of the only utilities offering a 20-year fixed price, long-term offtake price for renewable natural gas. And it has historically been at a premium close to 10 times historical spot gas pricing. So that foundational contract with a utility like Fortis is really what gives the assets that we own really high quality, reliable, reoccurring cash flow stream that we look for. And I think that's a little bit different. There's differences, nuances between the Canadian market for renewable natural gas and the US market, and that's a major one. So EverGen, it's a cash flow positive company today, and we've got a portfolio of assets in British Columbia, Ontario, and as well as a project that we're acquiring and in the process of acquiring in Alberta. So really looking to have a footprint across Canada. Just with the assets in our current portfolio, we've got line of sight to $30 million of EBITDA from about $3 million today. When we look at peer comparables in the space, that it looks like a couple $100 million market cap type company, or higher. I think if you look at some of the entities in the US, and that's just with what we have in our portfolio today. On top of that, we've been a first mover in the space. We've done 5 deals since our inception about 2 years ago, and we see a continued pipeline of growth, and that's above and beyond that, about 6 million gigajoules of annual reoccurring production from renewable natural gas assets that we're focused on consolidating in Canada. So I think with that, we'll talk about the nature of our assets. We'll demonstrate in the next few months the access to capital that we have for these projects, and to continue our growth and to really grow into a large scale platform in the space. I think Deborah covered this. There's just additional information on our capitalization and structure. We do have $20 million of cash, which we'll be deploying into our core portfolio that I mentioned, along with some incremental finance that will be related to the projects under our development, which of the profile that we're looking at. When we look at developing assets in this space, we see potential for up to 70% debt on these assets. Our goal out of the gate, though, is much less than that. We target about a 50% debt to equity ratio on the assets that we develop. So what is our business? I think this slide does a really good job. It's probably our favorite slide to talk to. It outlines the type of waste that we deal with, which is a little bit different depending on which which company you're looking at in the space, depending on which region they're operating in. What we like to have in the projects that we look at is a mixed feedstock combination in terms of bringing in on the front end food waste from municipalities. So two of our projects in the Lower Mainland in British Columbia take in municipal green bin waste on long-term contracts. So what we like about that is it's reliable. Yeah, the feedstock is relatively consistent, and it's solving a waste problem for the municipality. So this is waste that before it got diverted away from landfill would have ended up in landfill and would have been one of the largest sources of greenhouse gas emissions for the municipalities. Secondly, agricultural waste, we take in manure, we take in other animal waste, and thirdly, other organic sources, primarily being commercial waste, both pre-consumer and post-consumer restaurant food waste and that type of thing. And what we look at is having a variety of feedstocks on the front end of our projects for a couple of reasons. I think number one, as you can imagine, there's different energy contents with each of those feedstocks, depending on the organics that are actually in the feedstock coming in. And number two, there's also different tip fees. So we get paid to take municipal waste as an example. You get paid to process that from the municipalities, and that contributes to about 50% of our revenue over the long term. Is making sure that we've got an optimized mix of waste coming in on the front end to maximize our revenue on the front end, but also maximize our gas production, which leads to the revenue on the back end, which comes with the fixed price long-term contracts with our utility partners. The core of our business is developing, owning, and operating assets, everything that you see in the box in the middle. So this starts with processing the waste as it comes in on the front end, putting it through the digesters that Jennifer, I think, did a great job describing. You see them on the front of our slide deck. They are large concrete bins or cylinders, effectively, where the waste comes in. You put it up to a temperature where you get accelerated decomposition. You have retention time of typically 28 days or less, and off the top of the digester, you're getting biogas production, which is really just CO2 and methane. The biogas upgrading equipment, these are small gas processing skid units, very comparable to what you'd see in the oil and gas industry, but scaled down. And typically, you're looking at stripping out the CO2 and putting pure 98% or higher methane into the gas distribution network. And I think what we like about that is the tie-in point for us is at the edge of our facility, directly selling to FortisBC on our existing facility. What that does is it cuts out challenges with middlemen that have more stringent pipeline specs. Fortis is a long-term buyer of renewable natural gas, and they're looking to have the direct connection into facilities that produce it, like ours. The byproduct of all of this, as you can imagine, there's a ton of semi-liquid, semi-solid waste coming in the front end. Out the bottom of the digester, you get digestate, and this is used for fertilizer, for soil amendments. It really is a substitution for chemical fertilizers, and we think this market will develop, and this will turn into a revenue source. It's not something that we bank on today. So our sweet spot in Canada is looking at projects that are in the $30 to $50 million size range. A lot of that is just dependent on the accumulation of organic waste in a population sparse country like Canada. You don't get the large scale projects that you see in the US. But for us, what that means is there's a lot less competition when it goes to working with existing project developers, which has been our bread and butter through our first initial wave of acquisitions that we've done. And when we look at the value drivers for our projects, really there's twofolds, as I mentioned before: the feedstock revenue on the front end, the RNG revenue on the back end, and we're getting not only a fixed price from a utility on the back end, but we're also getting a fixed price from the municipalities on the front end. And above and beyond the base volumes that we put through our facilities, we've got additional upside of being able to process incremental waste on the front end, which turns into incremental gas on the back end. And that really is a key value driver for us. So our portfolio today, we span BC, Alberta, Ontario, and we're working on developing projects in Quebec as well. These are really the four leading jurisdictions in Canada that have put in place mandates for diverting organics away from landfills. So you're seeing more and more organics that need to find a home, need infrastructure to be developed to process those organics. And on both ends of the country, both FortisBC and Énergir in Quebec have mandates for a fixed volume of their gas to be RNG or to come from renewable sources. And RNG is the fuel of today that they can substitute directly into their system and get gas production that is carbon negative from our facilities. So now just quickly getting into the transition that we're going through as we build out our projects. Our core portfolio in British Columbia is about a $45 million spend across our two assets in Abbotsford that will take our EBITDA from about $3 million to $8 million, and will double our input waste on the front end and triple our RNG production on the back end. We're adding a digester to our project at Fraser Valley Biogas, or two digesters, I should say, and we're adding new digesters to a facility that we own in Abbotsford that currently just takes in organics from the municipalities and sells compost. We're adding the same infrastructure that we have at our other project in terms of being able to process that waste on a long-term basis. In Alberta, we've got a facility that we're in the process of closing a transaction on, where we're coming in, and I think this is indicative of the opportunities that we see in the space. Coming in as both a technical expert in the RNG space, a capital provider to RNG projects, and a strong partner to existing developers. So in this case, this is a family-owned operation that's been producing biogas from manure from their own farm for about 8 years. We're coming into this project. We're acquiring a 67% interest in the facility, and then we're working with them to expand this and turn it into not just currently the biogas gets used for power generation and the power gets used on their farm. We'll be adding a renewable natural gas upgrading unit. So think of this as an additional skid that will get installed on site. And the biogas will then be purified, put into the pipeline, the local pipeline, and then there's a long-term offtake contract, and we'll be selling that gas to FortisBC as well. So this project is located in Lethbridge, will flow through the Alberta network, and then is tied into FortisBC. What we like about this is there's a ton of feedstock in Alberta that currently doesn't have a home in the same way that you see feedstock used for waste to energy in other parts of the world, in BC and Ontario, and certainly in the US. So we think there's a lot of growth out of this asset. We're looking at a total investment over acquisition costs plus additional CapEx for phase 1 and 2 of about $15 million, and a facility that will generate $3 million in an area that we think is capable of generating over $10 million in terms of the projects that we see developing in and around this facility. And then just recently, we've partnered with a developer in Ontario that's been working on something that's a little bit different in the space. This is an agricultural focused project focused on aggregating waste from corn. So this is post-harvest, called corn stover, is one of the primary inputs of this project and these facilities, as well as corn silage. And this is what's nice about this project is we're stepping into a partnership with a developer who's been working on this for about 2 years. They have offtake agreements that they have been negotiating. They have a strong partnership on the feedstock side with a local aggregator, a large but also local presence aggregator of agricultural products. So think of this as a logistics provider for farmers. They're providing the feedstock to these facilities, and then ultimately what's interesting about this is the scale. So it's about a $200 million 3-phase development that will produce 1.7 million gigajoules per year, which at the pricing that we're seeing utilities pay north of $30 a gigajoule on a fixed price contract, you're looking at close to $60 million of revenue, with EBITDA margins at the 50% level. That's about $30 million of EBITDA out of a project like this, long-term, contracted, both on the feedstock side, on the offtake side, and that's where we're seeing lots of interest in the private markets for developing projects like this. I think I've covered everything, briefly, and I don't want to take up too much time on given that we want to get to the panel at the end. But I think the only last thing I wanted to touch on was our pipeline. So what we have discussed so far are 5 projects across BC, Alberta, and Ontario, take us to 2 million gigajoules per year of growth. What we're looking at is a project portfolio of 25 plus projects that we're looking to aggregate across Canada that look exactly the same as what we have in our portfolio today. So I think there's a lot of work to be done in Canada. I think there's lots of interesting things happening in other jurisdictions, but I think we've got a clear pathway to growth in Canada and a lot of unique advantages to continue to grow our business here. And I think that's our focus at the current period of time. So with that, I'll leave it there, and I'll turn it back over to Deborah.
Thank you very much, Chase.